Hey, welcome to your online enrollment area, or as I like to call it, the Capital Raising Toolkit. Inside this online enrollment area, over here on this side of the page, you'll notice we have all of the learning modules, the curriculum, all designed to do one thing, make raising capital your new superpower. You'll see up here what I call the 4-step blueprint. That's one of the key fundamental lessons inside this program, as well as the trust sequence and also the $1 million pitch. As you go through the curriculum, you'll also find out that you have access to many other tools, things like examples of pitch decks, as well as offering memorandums, so that you can emulate the best of the best. If at any time you need help, or you're hung up, or you're stuck, we're simply an email or phone call away. You'll notice at the very top of the page our email address. You can reach out to us at info@bradblazar.com. Again, I want to thank you for investing in yourself, getting access to our online enrollment area, and most importantly, making capital raising your new superpower. So let's go ahead and get started, folks. Welcome to Capital School again on Thursday night. You know, we're here every night at 5 p.m. Central Standard Time. Does anybody have any questions over the material that we covered the first session, which is the 4-step sales blueprint, whether it's the blueprint, what you do on each one of the 4 calls, or any questions on kind of the mindset that you have to adopt in reaching out to people and connecting with investors? Any concern or any issues there at all with anybody?
No.
I'll take that as a no. Beautiful. No. Okay. Just remember, folks, that if you purchase a list of investors, and tomorrow we're going to be uploading actually some contact information for somebody that I've actually worked with for many, many years. This guy's been in the business working with individuals that are raising money. He's worked with financial planners. He's worked with people in the investment community, basically making available lists so that you can get a prospect list and begin the process of reaching out to, calling, or organizing Zooms, that when you're reaching out to people, you don't want to be selling or pitching until that third call. You want to build trust, you want to build relationship. But Brad, Pray, I think you've actually already talked to Tony Panico, haven't you?
I did. We're actually having coffee next week.
Oh, beautiful. Yeah, it's funny. These two guys, my list guy that basically puts together these lists, and Brad literally live like 15 minutes apart. So they've talked, and now they're connecting and actually getting together for coffee next week. But was there anything that Tony shared that you maybe want to share with the group about how the lists are put together, or kind of the demographics in terms of the types of demographics that he can actually pull for you based on kind of the calls that you've had with him?
I mean, first and foremost, Tony seems like a pretty straight shooter right off the bat. I had spoken to him about some of the parameters that you had given me in order to pull a list. And he was like, okay, we can pull a list that way. I could also do it this way, and I could do it this way. And let's see what comes up with the best results. Mm-hmm. So that's actually what he did. He actually played around with it to see which one came up with the best results for me. And then, we spoke about pricing, and because it only came up a little bit over 3,000 for the area we're looking in. So it's just, he's actually going to give me, and this has to do with the whole DNC thing, but he's going to feed me part of the list little by little. Yep. That way I could stay current on the DNC list and not have to worry about calling somebody who's on it.
Exactly. And for those of you that don't know, the DNC is the National Do Not Call Registry, where people that don't want to be spammed and cold called with solicitors, they call and they register their phone number. And so this company, who I've worked with, Tony Panico at Partners for Marketing, that can source a list for you, kind of scrubs this list fairly regularly to make sure that, hey, if you call somebody that you're not going to get in trouble, you're not going to have this person on the other end say, hey, how did you get my number? I'm on the National Do Not Call Registry. Like I said the last time, when you're calling people or when you're reaching out to investors, if you're working a list, probably the most embarrassing thing that can ever happen is, somebody passed away in the last year, year and a half, and they're still on the list and it just hasn't been updated. And so, you just apologize like you would to anybody. And then of course, just move on to the next person on the list. But yeah, great that you're actually moving forward. And for those of you that saw what I had actually put up in the Capital School Facebook, Brad's off to the races. He's got his offering memorandum. We got the PowerPoint he's been working on. He's got his one pager. And so he's kind of at the stage, folks, where, now it's moving forward and actually kind of beginning the process of building his investor network and actually raising capital. So great job. Thank you so much for sharing that. What about the other session we did last week? Any questions on crowdfunding, any of the platforms, how you leverage the platforms or anything like that from anybody in the group? Great. All right, folks. Well, tonight.
Question on that list that Brad's doing. Is there a ballpark cost on what's going to cost you, Brad?
Yeah, actually, I have it written down. I know for my list. Here we go. Because he's given us all, the Brad Blazar special. For 1,000 leads, you get an extra 500 free for $225. So 1,500 leads for $225. And then if you order 2,000 leads, which is $300, he gives you 1,000 free. So 3,000 for $300.
Yeah, like I said, guys, you can have a pretty substantial list to email, to invite to meetings for, well under $1,000. I mean, pulling together a list of high net worth accredited households to reach out to, you're talking a couple $100. I mean, I've bought lists from Tony where I've bought 5,000 and he's given me an extra 1,000 on top of that. So 6,000 households. And then, what we've done is we've worked with some of these mail houses where we design a nice invitation and they'll do a mail merge and they send out a nice invitation in the mail to everybody and they show up at an event that will host, a lunch and learn or wine tasting. And, you're off to the races. You'll have 150 or so people respond and you might do it over 2 days where you have a Tuesday option and a Thursday option. So depending on people's calendars, you have a little bit of flexibility. And, like I said, you don't want to be doing these big expensive steak dinners. That's a no-no because you get a bunch of plate liquors. But if you just do something, that's, wine tasting or, something during the middle of the day where you don't have to serve a big dinner, what you'll find is the people that come are the people that are interested, Let's face it. I mean, if you're not serving a big steak dinner with lobster tails, they know that they're coming for this purpose because it's in the invitation. You're telling them. And so you're going to get much better qualified investors and much better leads. Today, we're going to focus on a real important topic, folks. You definitely want to listen up. You want to take some notes. The most important thing is if you do not do the things that we're going to be discussing this evening, you can get in a world of hurt. Matter of fact, you can actually end up going to jail, or worse yet, you can have your entire offering rescinded by the people that are the regulators that oversee the industries that you're going to be working in, primarily, of course, the investment industry. Whenever you take somebody's money with the intent that that person is going to create a profit or make money, you're selling a security. And so I want to make sure that anybody that does this understands the rules and the regulations behind it, so that the second you start making money, number one is you're not breaking any laws. And more importantly, number two, you're not putting yourself in harm's way, or worse yet, you're not putting your offering in harm's way. Because, you can go out and raise $5 million and think that you're up and running, and all of a sudden, a regulator comes through your door and says, hey, we understand that you've raised some capital here. We never saw that you filed Reg D. And you're like, well, what the hell's Reg D? You don't know, or your attorney never told you about it. All of a sudden they say, your entire offering is rescinded. You've got to give all of your investors the right to get their money back. And then they take over. I've seen it happen to people in the business, folks. It's ugly. It's messy. You don't want to be there. So the first thing I want to cover
is, are these regs standard across the lot? Like, so is there anything extra I need to do as a non-US citizen resident?
I want to talk generally about regulations that apply primarily here, of course, in the United States, Marcus. Great question. Obviously, you're down in New Zealand. What I would do is take notes and obviously listen. And then if you're going to be raising money primarily down there in New Zealand, Australia, and quote that
I'm
part
looking
of the
at
world.
the US. I'm actually looking at US. I actually got my exemption, so I'll be in Los Angeles on the 1st of December.
Oh, okay. There you go. Okay. So then, yeah, you definitely want to pay attention here. So the first thing that I really want to focus on tonight, which is very, very important in your understanding as it relates to raising money, is the definition between what we call a non-accredited investor and an accredited investor, because there's a big difference. The difference basically is in net worth, and the difference, of course, is in their financial stature and their ability to predominantly, suffer a loss. So let's talk about an accredited investor. When we use the term accredited investor as we're raising money, basically what we're saying is if that person were to lose the investment, yeah, it's going to hurt, but it ain't going to kill them. Okay. In other words, they've got the financial means, they've got the income, they've got $1 million net worth. While it's painful whenever you lose money, it's not going to obviously put them under a bridge or really kill them. And so a accredited investor, by definition, is an individual that has earned $200,000 in earned income in the most recent 2 years, or if they're married with a spouse, have a combined household income of $300,000, or irrespective, if they don't meet the income thresholds, they have a net worth of $1 million. Okay, so, guys, doctor, or he's a, professional, he's making $250,000, $300,000 a year. He's been doing that for the last 4 or 5 years. He's by definition an accredited investor. Now, you have a lot of people that may make only 100, 120,000, so they don't meet the threshold, but they've been very prudent. They've saved, and they've made wise investments, and they may have a $2 or $3 million net worth. Boom, they are an accredited investor. Now, everybody else that's not accredited by definition is basically non-accredited. Non-accredited investors can still invest with you based on the things we're going to discuss tonight, but there are certain guidelines and there are certain additional disclosures that you have to share with non-accredited investors because they're not people of affluence. In other words, they may only have a net worth of $300,000-$400,000 and they may only be making 80 grand a year. And if they invest, $50,000 with you, that represents a much larger proportionate share of their overall net worth, where it's a lot harder for them to get that money back than it is for somebody making a couple $100,000 a year or that has a 7-figure net worth. So what I want to cover tonight are some of the securities regulations that allow you to make money, and they're very flexible. And when you're starting to raise capital, you've got to give some thought to this. And more importantly, you've got to give some thought to the universe of investors that you're going to be reaching out to and that you're going to be approaching. And so the first regulatory body or the first regulation that I want to talk about is the most common. I would say that probably 90 to 95% of the people that are raising money use what we call Regulation D, or what we call Reg D. Reg D is basically what we refer to as a safe harbor provision, where you, as somebody that wants to raise capital, can basically utilize this Reg D exemption and raise basically an unlimited amount of money. There's no dollar limit on the amount of money that you can raise under Regulation D. Now, with Reg D, there's basically 2 paths you can go down. It wasn't always that way. There used to be just one Reg D, and what that older version of Reg D said is you can raise an unlimited amount of money. You can have basically an unlimited number of accredited investors, and you can have 35 non-accredited investors. And that's the secret right there. If you're going to do a Reg D, and it's called Rule 506B, okay, Rule 506B, You can have 35 investors that are not accredited. That is okay. Okay. Which means, you can have somebody that, invest 20, 25,000 in your deal. They're not accredited. That's okay. But here's the key. When you start taking money from non-accredited investors, the standard goes up tremendously as to disclosure, because the Securities and Exchange Commission and the state regulators in the various states are of the mindset that this person who is non-accredited is not a sophisticated investor. Okay, therefore, he needs more financial disclosure. He needs to see things maybe like the income statement for the business, or he needs to see something like a balance sheet for the business. And so if you're working with an investor that's non-accredited, or you plan to have non-accredited investors, what the regulators basically say then is that you've got to maintain the same disclosure requirements as if you were doing what we call a Regulation A. That simply means that you have to provide that non-accredited investor with an audited balance sheet. Now, what does it cost to get an audited balance sheet? A couple $1,000. Your income statements and all the other statements don't have to be audited, but if you're going to take money from a non-accredited investor, you've got to provide them with an audited balance sheet, and you've got to have a little bit more disclosure. So for some of you that are getting started at this, that are going to be raising some money, that want to go down the Reg D route, my recommendation is don't deal with non-accredited investors. Just make sure every one of your investors are accredited, okay? And the way you do that is one of a couple ways. Number one, in your subscription agreements, which are part of the offering memorandum, that's where people basically are sharing their information, their name, their social security, their mailing address. You have a checklist. And we're going to get into the offering template and the offering document next week, where you'll see this live. But you have questions, and they just have to initial these various questions. Are you an accredited investor by definition? Here's the definition. And if they're not, you can't take their money. Okay, if you do, you're breaking the law. And then there's, other guidelines as well. The other way that you can also guarantee that they're an accredited investor, and this is very common. So if you ask for this, don't think that this person has never heard it before. They're used to this. I get asked this all the time. You say, are you by definition an accredited investor, Marcus? Yes, I am. Great. One of the things that we require in order to accept your subscription into our offering is what we refer to as a CPA letter. This is simply a letter from your certified public accountant or the person that prepares your taxes that basically attests to the fact that you are accredited. And that's great. All he has to do is just call his accountant or the person that does his tax returns and say, hey, I'm making an investment. Need you to do me a favor. And then boom, you've now got a third party that is saying this individual by definition is accredited. Now, a lot of times they might say, well, I don't have a CPA. I use TurboTax, or I use, some other software to do my taxes. Okay, well, that's fine. Can you do us a favor and just send us the first 2 pages of the last 2 years? We don't need the whole return, but just the first 2 pages that show the amount of income that you reported. So again, we can basically ascertain that you're an accredited investor. And then the third, which is the one that I recommend, but it does cost about $30, $35 per investor. You just have to build that in to the cost of your raise. Is there are companies out there that will take over for you and basically handle the accreditation certification. They'll work with that person, and then basically they will send information to you as the sponsor or the issuer that says, we have reached out to this person. We've gathered this information, and by definition, we are certifying that they are accredited. The reason I like that approach more than any of the others, folks, is the burden is now on that third-party company. If anything ever happens where the deal blows up, things don't work out the way you intended, and God forbid, we hope it never happens, but it can. You end up in litigation or arbitration, and the defense attorney says, well, the plaintiff attorney says, well, how did you know this kind was accredited? You say, well, we relied on these people over here. We're not the ones that ascertain that. We relied on these experts over here. So now they're on the hook. It's just another what I call CYA, folks. It's called cover your ass. So understand that if you're going to do this, my recommendation as you're getting started is to start with the accredited investors. Okay, so now we have Regulation D. Regulation D says you can raise an unlimited amount of money. Doesn't matter if it's 5 million, doesn't matter if it's 25 million, doesn't matter if it's $100 million, okay? But here's the difference. There are two types of Reg Ds now. There's what we call a 506B like boy, and there's a Rule 506C like Charlie, okay? Rule 506C like Charlie evolved under the New Jobs Act that basically, came around under the Obama administration to basically stimulate the economy and to get more money freely into different types of investments. And so here's the thing. If you're doing a Reg D 506B, where you can have these non-accredited investors, you cannot do what we call general solicitation, meaning you cannot go to Facebook or to LinkedIn and say, hey, we're doing this great deal. Is anybody interested? We call this basically a no general solicitation offering. And basically what the guidelines say is that you have to have, quote, an existing relationship with the investor. In other words, what they really want to know is, do you know this person? Now, let's face it, if you're working off a list, you don't know the person. if somebody's introduced to you at a networking event or referred to you, you don't know the person. So does that hopefully answer the reason, folks, for all of you on the call, why we have a 4-step sales blueprint? By the time you get to the third call, you know the person. So that's how you cover yourself in this process, because if you can't use general solicitation by advertising or putting something on the internet, if you're just reaching out off of a list or you're doing an event, you're going to know the person on the third call because you've already talked to them on 2 prior occasions. You've qualified them. You've asked things over the course of those 2 calls, like what else have you invested in? How did those work out for you? You're building trust. You're building a relationship. So now you've got a bulletproof defense under the guidelines. You've protected yourself because now you've got a relationship, okay? So that's very important. So under the 506B, no general solicitation. You can have an unlimited number of accredited investors and 35 non-accredited investors. And then here's probably one of the most important things. You, or preferably an attorney that you've got a good relationship with, has to file what we call Form D. It's a pretty simple form, but it's called Form D. It's available on the SEC's website. Their website is sec.gov, G-O-V, which is the Securities and Exchange Commission. And you just go up there and you put in Form D, and it'll open up in a fillable PDF. And basically, they're just asking, who is the issuer? Who's the person raising money? Now, the SEC says that you have to file Form D, okay, 15 days after you get your first investor. So not later than 15 days after your first sale or your first investor. Do you have to file it up front before you even are off to the races? No. Don't spend your time. Don't waste your money filing it when you're getting started. But once you make that first sale and you've got your first investor, the clock starts ticking. You've got to file and notify now the Securities and Exchange Commission that you're in the business of raising capital and you're seeking what we call the safe harbor exemption under Reg D to raise money, and you've got 15 days to do it. The other thing that's important is to understand as you're talking to investors that when you're doing these types of offerings like limited partnerships and Reg Ds, that what you're selling, which is the investment, is basically what we call a restricted security. That means there's no free market for this. This isn't like a stock where you can call the broker and get out of this tomorrow, Mr. Jones. These are restricted securities that basically have no market. They have no resale. Okay, it's what we call a restricted security. You're investing long-term. You know that it's going to be 3 to 5 years or 4 to 6 years until we sell this building or we unwind the opportunity and we distribute the proceeds back to you. And that's what we call a restricted security. It means basically that, you're restricted from selling it. Now, here's my guideline. If you have an investor that you're ever dealing with whose situation changes financially and they come to you and they say, Mike, or they say, Law, you know, things have changed. I lost my job and man, we're in a world of hurt. It would really help us if we can get our money back. The first thing that you want to do is you want to reach out to the other investors that you may have in that deal. If you've got other investors, you want to give them the first opportunity. And so you send an email or you say, send out a letter, say, you know, hey, one of our partners has encountered some hardships. And so they want to basically relinquish their interest in the deal. I'm reaching out to any and all people or any of you interested. And, you know, a lot of times they're like, yeah, heck yeah, man, this deal's going great. I'll be more than happy to take over their shares. And so you just, you know, get that investor to write a check and you turn around and you trade it out to the other investor. That's fine. The other is sometimes you may want to create the liquidity, assuming you have the wherewithal to basically just cash that investor out. And now you own a bigger piece of the deal yourself. We've done that a couple times for some of our partners where we've written checks for 25, 50,000, because here's the thing, folks, you don't want somebody in your deal that don't want to be there. You don't want somebody there that is disgruntled or has a sense of, man, you know, I asked and they're screwing me and I really need this money. That's just not the right way to treat people. So just realize as you're raising money that those things may or may not happen. And if they do, treat them fairly, take the approach I've recommended, and you'll be fine. Now, the other type of raise, and this is the one generally that I recommend, we probably do 75 to 80% of the work that my team and I do in this area, and it's called the Reg D 506C. And the thing I love about this, folks, is under the Jobs Act, they basically gave us the ability to use general solicitation. You can advertise. You can put an ad in a newspaper. You can put an ad in something like the Rob Report, which is a magazine that goes out to rich people. You can put something on your Facebook page. You can put something on your LinkedIn profile. And you see companies that are doing this, folks, all the time. You know, for those of you that are big on Facebook, you probably have seen some real estate companies that say, you know, hey, look at what we're doing. And then they have a little learn more, you know, click here and it takes you to a nice website. Those are what we call sponsored or promoted ads on Facebook, and they're not expensive. And you can target on Facebook your ads like a laser and say, boom, I want to go to high net worth investors. Boom, I want to go to real estate people. Boom, I want to go, you know, over to this group. And then when people click on that, you're capturing emails, maybe you're capturing telephone numbers. That's okay. You're creating basically this network and you're fishing, I call it, for leads. And those leads, and then of course, become basically people that you can reach out to and say, you know, hey, Adrian, thank you so much for reaching out to us on our deal that we're doing in Naples, Florida. Or Law, thank you so much for getting our free ebook as a download. Wanted to give you a call and answer any questions you have and tell you what we're doing. So general solicitation or advertising under this exemption is great. That's what I love about it. You can do it. You're not breaking any laws as long as the investors are all accredited. That's the caveat.
I'm sorry, Brad.
You can advertise, you can fish for leads, as long as all of the people that you're working with, basically, folks, are accredited investors, you're fine. And so realize that that's the beautiful thing about Reg D 506C. Now, all of the other guidelines that I talked about, the Reg D form that has to be filed, got to do that, okay? But you're off to the races. Now, there's a couple of other beautiful opportunities that I want to discuss as well. Last week, as you know, we talked about crowdfunding, right? We talked about the ability to take your opportunity and put it up on the internet on platforms like Realty Mogul and Rich Dad and Fundrise. There's a whole bunch of them out there. If you look in our enrollment area, there's the list, of course, also in the Facebook group. So they have a new regulation that they just came out with recently. It's called Regulation Crowdfunding. So basically, they've given it the acronym Reg CF. CF stands for crowdfunding. And here's the thing, under regulation CF, okay, you can raise up to just $1 million in any 12-month period. So, if you're doing a small deal where you just need to raise a couple $100,000 to buy a fourplex, or, you don't need to raise $5 million, $10 million, you're not really focused on building a fund. Maybe, you've been dabbling in some single family and you have an opportunity to buy an 8-unit or a 12-unit building, and you only need to raise $800,000 and you're only going to do it as a one-time deal. Crowdfund it. Okay, take it to the internet, man, and leverage that huge market that they have with all of their investors around the world. And so with the crowdfunding Reg D, you can raise up to 1 million in a 12-month period. But here's the thing, the investment opportunity to do this has to be made exclusively through these platforms. In other words, you can't talk to people. You can't be soliciting people yourself. You have to rely on those platforms that we talked about last week and upload the offering to that platform to raise this capital and to raise that money. The other thing is that you have to basically, now the thing about it is it doesn't matter whether they're accredited or non-accredited, but it requires, like Reg D, the preparation of another form that they call Form C. Okay, so just remember, if you're doing a Reg D, it's Reg D. If you're doing a Reg CF, you've got to file this form, which is the Form C, and you have to file that with the Securities and Exchange Commission. And the same thing applies. These are generally restricted securities. You can't transfer them. You really can't, do anything with them. And you just, explain that to the investors that, hey, here's how this works. We're in this deal together for the next couple of years until we are able to build value and then sell the property or sell the business or have some other type of a monetization event where we're going to be able to, get you out of the deal and unwind the deal. So the other thing that I wanted to discuss tonight as well is another type of offering that we see a little bit of, and that's called a Rule 504, okay? A Rule 504 allows you to raise up to $5 million over a 12-month period, okay? Now, with the 504, it's very similar to the Reg D 506B in that you can have no general solicitation. You can't do any advertising. You can't do any of that type of stuff. But you can have investors come in, but here's the thing that is a little different. When you're doing a 504, the SEC and the state regulators say you cannot have any bad actors, okay, involved in the transaction or the deal. What does that mean? When you're raising money, okay, the securities industry looks basically to the people that are behind the deal. So if it's you and let's say a partner, or it's you and maybe a couple of partners and you've created this business, what the regulators look for are what they call bad actors. And if you're a bad actor, you can't be involved in the deal. Now, the definition of a bad actor generally is tied to the securities industry. And it says if you as an individual have basically been charged or found guilty of securities fraud or breaking the law in the securities industry or doing something really bad like committing mail fraud, running a Ponzi scheme, you're a bad dude. And basically they don't want you involved in the business of raising money. Okay, so hopefully that makes sense. And so again, just like filing the Reg D, if you're a bad dude and, it's only been 5 or 6 years and they find out, again, you can get in a world of hurt. Same thing with your partners. So you want to kind of do a little bit of a background check on anybody that you're going to be affiliated with in the business of raising capital. Now you can go online and I'll download and I'll put in the enrollment area and also in the Facebook group, the definition of what a quote bad actor is. But just realize basically that you don't want to, be a part of that. The other thing that's pretty cool that I've seen some people do, which is a little bit more expensive, but it's really a neat thing to be doing if you're doing real estate, which is kind of why I wanted to bring this up, is instead of doing a limited partnership, or instead of doing something like we're talking about, which is a Reg D, is you form what we call a private non-traded REIT. Okay. Now, what's a REIT? A REIT stands for Real Estate Investment Trust. And for any of you that are doing real estate that want to put together a fund and raise like, 20, $25 million and build, kind of like a real estate private equity firm, or you have ambitions over the course of like 2 years to raise $25 million, what you might consider doing is doing what we call a private REIT. Okay, now the difference between a real estate investment trust and like a Reg D or like a limited partnership is a REIT, or a real estate investment trust, is treated as a corporate entity. Okay, people basically are buying shares in a corporation. And the major difference is in the tax reporting of what your investors get. Because they're investing in a real estate investment trust, which by definition, they're buying shares in a corporation, they get a 1099. People love 1099s. Why? Because they're not nearly as complicated as what we call a K1. So if any of you have ever invested in partnerships before and have received a K1, you know what I'm talking about. But basically, as you're raising money, folks, and as this deal, whether it's a building or whether it's a business, is generating income and generating losses and depreciation, you got to figure out how you're going to communicate all that stuff to your partners the following year, because you've got to send them some type of information that they can put on their tax return. And there's two things. There's a K1, there's a 1099. Your CPA or your accountant, or if you have a CFO or you're working with a comptroller, can keep all of that information like a bookkeeper would, but you're going to have to provide some reporting. And the beautiful thing about a private REIT is it's easier. It's a 1099. So for the investor, it's easier reporting. But here's the deal. If you do this for many years and you become very successful at it, like many people have, you can take these various, what we call private REITs, and kind of bundle them together. And then you can actually go public and take it public. And we call that a public offering, or a public REIT, where you file with the SEC, you put them on notice, and then essentially you can list it. You can go to the New York Stock Exchange or one of these exchanges, just like the Real Estate Investment Trust. And now you get people all over the world investing in shares of your company. So it's just a different strategy, and it's a way to raise capital. Now, another thing that some of you might want to look at that I also like and I'm a big proponent of is, if you're in the real estate space, you have to understand the different opportunities to investors. One, of course, is you're just investing in real estate. But the other big, huge opportunity of investing in real estate basically is what we call a 1031. Okay. Some of you on the call tonight may or may not know what a 1031 is. If you do, great. For those that don't know what a 1031 is, I'm going to explain it to you. Let's say that I'm a doctor and I have a medical practice, and I decided a long time ago I didn't want to rent space in an office building. I wanted to physically own my real estate and have people come to see me in my practice in a building that I physically own. And instead of paying rent, I'm paying a mortgage. Or better yet, maybe now I own it outright because I paid it off. So now I'm retiring. I'm 68 years old. I'm selling off my medical practice. Okay, I'm getting out of the business, but I've got this big building. If I sell it, I'm going to be in a world of hurt because there's huge capital gains. I'm going to have to pay a lot of tax. What a 1031 allows me to do is basically take that building and sell it and roll the profits into another piece of real estate with certain guidelines and not pay the taxes. I can defer the taxes. Okay. And the beautiful thing is, as an investor, I can do it again. I can do it again. And if something ever happens to me, my beneficiaries get a stepped up cost basis where essentially all of the taxes that would have been due are put in the ground right behind me in a nice little casket where my beneficiaries don't really have to pay all of these capital gains taxes. It's one of the best tax planning strategies that exist in real estate for people. But here's the guideline. When you're an investor that has a building that you're selling, if you want to take advantage of this 1031 strategy, the IRS says that when you sell, you cannot take possession of the funds. Okay, you have to make the decision before you physically sell this piece of real estate that you're going to do a 1031. And what you locate through a title company is what we call a qualified intermediary. Okay, a lot of big law firms will act as this, but a lot of times it's just a title company. And that means that when you sell, the money is held in a qualified intermediary escrow account. Then the investor has 45 days to find a replacement property, something to invest that money into. They can do it in an apartment building. They can invest it in a self-storage. There are professional companies that do syndicated deals that people can put their money into. And then once you identify in 45 days what you want to invest in, you have 180 days to then wrap up and close the transaction. And if you do, you're cool. You don't have to pay capital gains tax. You're now in a new deal. Your money's continuing to grow, tax deferred. You haven't paid any capital gains. And then that deal sells 5 to 7 years later, and then you just do it again. So you're compounding your money just like you would in an IRA account where you're not paying any capital gains taxes. Now, at some point, if you want to take the money out, you would. But like I said, one of the best planning strategies for wealthy people in their estate is just continue to do that. And then when you drop dead, your beneficiaries get a stepped up cost basis on the value of the investment that day. And then they can go to that issuer sponsor and say, you know, hey, we're not as interested in real estate as granddad was. We'd like to get out of the deal. And they get out basically at a stepped up cost basis. And there's a very, very small amount of taxes that would then be due. But the reason I like this, for those of you that are in real estate, maybe doing like an apartment building deal or doing like a strip center deal, is if you can package it and create an opportunity to bring in investors under a tenant in common structure or another structure the IRS recognizes called a DST, a Delaware Statutory Trust, you create urgency. There's nothing better when you're talking to an investor than urgency. Imagine you got a guy that owned a building that wants to do a 1031 and you're talking to him, and that first conversation you have with that dude is like 20 days into that 45-day window. This guy's only got 3 weeks to make a decision. And if he doesn't, he's got a big tax bill. And so that's one of the strategies that I've employed doing deals, is to structure them this way, because now when I'm in front of an investor, I'm like, where are you in your 45-day identification window? And a lot of times they're right at the end, man. It's like, I only got 8 days left. Well, shit, you got to make a decision, boy. You either in or out of the deal. Send me the stuff. Okay, I'll call you next week on Tuesday, the day before that window closes. So that's some of the tools that you can use as you're raising money from different types of investors. So this evening, we've covered a lot, and I know that it's confusing the first time you hear about it because there's all these different regulations, there's all these different things that you have to do, and that's why we're going to upload this into the enrollment section. I'm going to actually have a really nice chart that breaks it down. Here's what a Reg D is, here's what a Reg A is, here's what a 506B is, here's what a 506C is, here's the deals you can do, accredited, non-accredited investors, et cetera, et cetera. So it makes it real cookie cutter and real easy. Now, there's a couple others that some of you may or may not have knowledge of, like Rule 147 or Reg A. I'm not going to go into those tonight. They'll be on the sheet for anybody that's interested in just having knowledge or looking at other options. But like I said earlier on the call, literally 90 to 95% of anybody raising money is going to do it as a Reg D. Why? Because it's simple. You stay out of trouble. You only have to file one form. You can advertise. You can solicit. You can reach out on Facebook or LinkedIn and start building a pipeline of activity there. And, what I explain to people that want to raise capital, and I've kind of shared this with Brad, who's on the call, who's already built his investor kit that, was talking earlier, is sometimes you want to cast out multiple nets, which is okay. You want to look at various ways to get your deal in front of as many investors as possible. And so you might work with somebody like, Tony Panico, who Brad mentioned he's having coffee with, who will sell you a high net worth accredited investor list for a couple $100 and then start using that. Okay. A second avenue is you might want to put this out there on your Facebook and your LinkedIn. Start using that as a source of lead revenue as well. Then, if you're not doing the Reg CF that says you have to do it on the platform, if you're just doing a Reg D, you can upload it to any one of these crowdfunding platforms and leverage that as well. So basically, it's like a fisherman, right? You've got 3 different nets out here that you're working for leads. And you're working all of those leads using this 4-step sales blueprint. So when you finally get somebody, you're not selling them or pitching them right out of the gate. You're, again, building that trust. Hey, don't have anything I can sell you tonight, Mike. We always give our investors the first right of refusal. So typically a lot of them just, go from one deal to the next. And it's very rare that we ever have an opening, a matter of fact. But, in the event I do down the road in the future, man, I'd love to give you a call. Is that okay? See, again, you're using this mentality of the takeaway sale, building the scarcity, and more importantly, building the trust. And then somewhere during that first, second call, you just do another, what we call non-linear touch with an email, maybe pushing something out, discussing the tax benefits or the advantage of what it is you're doing, so that that prospect says, man, this person's adding some value. He's helping me. He has my best interest at heart. You're going to have a much better probability of winning over an investor than just coming right out of the gate saying, hey, man, thank you so much for downloading our stuff on Facebook. Hey, here's what we're doing. Love to have you as an investor. Can I send you the stuff? Don't work that way. You got to realize when you're raising money, folks, that it takes time. That's the one thing I will tell you about raising money that sucks. I wish I could change it and speed it up. But, it is a process, and you've got to go into this understanding it is a process. But here's the best part about it. Once you start getting a few investors, then you start getting referrals to new investors. Okay, and that's the beautiful part of this. It gets easier as you build relationships and as you treat people fairly and as they see that you're doing all of the things you said you were going to do when the relationship started. And so imagine you've got an investor, he's in your deal, he's been in it for 4 or 5 months, he's seen some checks, okay, he's seen maybe your quarterly report that you put together to update everybody. And then it's like, Adrian, who are you connected with that we need to meet that might be a good prospect for our next deal? And hopefully you'll get a couple of good leads. Or better yet, the investor himself will call you and say, hey, I'm in a business where I spend a lot of time talking to people that have money. When I was in the oil business, we had a whole bunch of airline pilots, a whole bunch. Well, why do you think that? They're sitting in an airplane next to each other for 4 hours, flying from one coast to the next coast. And so over the course of the call, they talk about their investments and what they're investing in. And, just one dude just has to say, man, I'm investing in a couple of oil wells. I'm getting some great tax benefits and it's saving me a shitload of money. Really? Well, tell me, how do I do that? Well, you get to call these guys. So it works, but you got to work the system. You got to work the system, and the system will work for you, folks. So as we kind of wrap up tonight and get towards the top of the hour, I know we've covered a lot. Any questions on any of the material that we covered tonight? The Reg D, the crowdfunding, the other securities regulations as it relates to, you have to file non-accredited, accredited investors, or anything that we've covered earlier on crowdfunding, which was last week or the first week on the 4-step sales blueprint. Any questions that anybody has as we kind of wrap up for tonight?
I do have a question.
Yep, go ahead, Adrian.
It's more so you were saying something about with the crowdfunding, and it said something about if you have the investors, is that with all of the crowdfunding? Like if you are saying that this is what I'm raising this money for, you can't do any other kind of advertisement? I thought I heard you say something like that. So my question was like, what if you do like t-shirts, things of that nature? Is that considered, you know what I mean? Is that considered a part of another form of fundraising?
Yep. So here's what you have to remember, and this will clearly be on this document that'll be uploaded to Facebook and also, of course, in the enrollment area for you and everybody else, Adrian. When you do what we call the regulation CF, where you're going to say, I'm going to raise money and I want to use these crowdfunding platforms, the first thing you have to remember is you can only raise $1 million over a 12-month period. So you're somewhat limited claiming this regulation CF to use these various crowdfunding platforms. Now, if you go the other path and you say, hey, I want to raise $10 million and I want to do a Reg D, then you can still take it to a crowdfunding platform, raise a much larger amount of money, and not have the same restrictions that you would have using this other regulation CF. Now, if you do the Reg CF, can you talk to people? No. Can you have t-shirts or advertise or do anything on Facebook? No. You're relying on them, the platform, to get you all the money. And if it's unsuccessful, there's nothing you can do about it. Okay. So a lot of times what people will do is they'll say, look, I only need to raise $800,000. Let me put it up there on one of these crowdfunding platforms under Reg CF. I'll file Form C and I'll give it, 4 to 6 months. Now, if they raise the money, great. But if they don't, what they then typically do is they'll take it off the platform. They'll end that relationship with that platform sponsor or issuer, and then they'll go and turn right around and put it out in the market again a month later as a Reg D or one of the other structures where now they can, have more control. They can advertise, they can promote, they can use Facebook, they can, still use the crowdfunding platform. And so that's why I said earlier, Adrian, 90 to 95% of all the money that's raised is usually one of those two Reg Ds, either the 506B, because you're going to have some non-accredited investors, or the 506C, where everybody has to be accredited. Yep. Does that answer your question?
Brad, just in regards to that, the Reg CF, so when you say up to 1 million within a 12-month period, is that per individual, per company, per deal, or like how is it broken up, or how is it structured into the 1 million?
Yep. So basically it's up to 1 million in any 12-month period. And so that would be basically for the issuer, for the person raising the capital.
Okay.
Yep. Good question. Good question. Yep. Yeah, Brad.
I just have a question. When we're, calling investors and we're giving them the spiel about how, we always give our previous investors a first right of refusal. We don't have anything to offer them right now. But then we call them back, 7-10 days later with an opportunity to invest into the fund. Now, it's not a deal, it's a fund. Mm-hmm. So am I overthinking it, looking at it as like, well, I actually had something to offer at the moment, but I'm just saying I didn't? You know what I mean? Because if I came to them with a deal, then I have something to offer, but the fund's basically always open.
Well, yeah, good question. Number one, don't forget, you're not offering anything until actually the third call. So the very first call, you're really just calling, hey, Brad, this is Brad Blazar at 5 Star Capital. I was just reaching out to you tonight. We're a real estate private equity firm and wanted to see if you have an interest in real estate as a sector. And whatever they say, again, you're trying to get them to stay on the phone and, build that relationship. Towards the end, as you're kind of wrapping up that first call, you just want to let them know, thank you so much for your time. I just want to let you know that it's very rare that we ever have openings in our programs because a lot of our prior investors will just basically renew. We always give our ensuing our existing investors, the right of first refusal. But let me send you some stuff and I'll check back with you here in a week just to make sure you received it and answer any questions you have. And then again, call number 2, you're not pitching or selling, you're just touching base, hey, just wanted to make sure you got the materials. Wonderful, great. If they say, yeah, I got them, but I haven't had a chance to read them, which is very common. That's again, when you just say, hey, if you have them available or handy, there's a couple of pages I'd literally just like to bring to your attention. So I'll wait, go find where it is. And then, you try to get them to, again, open up the materials you sent and bring their attention to a couple things. And again, you say, just want to preface, it's very rare that we have an opening on anything, but, I'll be more than happy to put you on my list. And in the event we have an opening at some point in the future, we'd love to get back in touch if I think it might be of interest to you. Great. The third call is now where you're going down your list. And it's just like, hey, Marcus, Brad Blazar, 5-star. Last time we spoke, I told you that it was very rare, but we have a small allocation that's come available on one of the deals we're working on. It's actually in our fund. And I'd love to tell you about it. It's a $5 million fund. We only have a small amount remaining, but here's what we're doing. And then it's on that third call that you actually then mail the kit that you're putting together out, which is your PowerPoint, the summary, the offering memorandum with the subdocs. And then hopefully on that fourth call, you're going through everything, you're answering questions, and hopefully you're closing and you're getting that person to commit their hard-earned money to your deal. You're walking them through the subscription paperwork, which we'll get to, like I said, next week, because we'll be going through the subdocs, we'll be going through the offering, and then of course we'll be providing that template so that anybody that's interested can begin preparing that document and get their offering kits put together. Yep.
Okay.
Right.
I guess I'm a little bit hung up on, like I was saying, if I was bringing them a deal,
Mm-hmm.
you know what I mean? I'm bringing it to them on the third call, but because it's a fund and the fund was open for them to invest in on the first call, even though I didn't bring, you understand what I'm trying to say?
Yeah.
I don't know if I'm
So I get it now. So really, what you could say if you have a fund is you're just waiting to hear from your existing investors because you always give them the right of prior refusal and you're still waiting for them to, make a decision. That's why you really don't know what the availability is. So it really doesn't negate or damage what you're doing, because even if you have a fund, and it's been open, you can just say, the reason I wasn't able to get back into you until this third call is, we were waiting to hear from our existing investors what they were going to do. Does that make sense?
Makes sense.
Yep. All right, everybody. Well, everybody have a wonderful night. Be safe, be well, happy Thursday. And we'll get everything uploaded, of course, in the enrollment area. So if you want to go back to look at it, if you want to refer to the list on all these different regulations, what I would advise is you just download it. Just keep it there in your office or on your desk and use it as a guide, because it's going to be very clear cut and very concise. It was actually put together by one of the biggest securities firms in the industry called Morrison Forster. So all the information on there is accurate. It's updated. And of course, if you have any questions, we're here for you. But everybody be well, be safe. Have a wonderful Thursday night. And we'll talk at you all next Thursday. Take care, everybody.
Thank you.